What's up everyone, it's Karthik with MoneyVest. So the most important week in the markets and perhaps one of the most important weeks in the world is finally here, because next week is of course my birthday on November 7th. I'm just kidding. It is of course the national elections, although my birthday is also next week on November 7th. So elections on November 5th. I'm going to break down exactly some of the information around the swing states and how that's really going to be the deciding factor in terms of who ends up winning this very highly contested and tight elections, as well as the FOMC meeting that literally is going to be on my birthday on November 7th. So I will be live to cover the entire meeting from Jerome Powell and of course what is going to be that interest rate decision, whether we're going to get a 25 basis point rate cut or they're going to keep rates steady. The market is pricing in for another 25 basis point cut. So I've got a lot of spreadsheets to also break down in this update. Make sure that you drop a like and subscribe to the channel, and do me a favor, share this video with your friends, family, traders, other investors in other groups that may want to get ready for what is arguably going to be one of the biggest weeks of 2024. So the US election day approaches on 5th November 2024 as the competition between Donald Trump and Kamala Harris is heating up, especially in the vital swing states, which I'll break down. There's 7 of them, and both candidates are making final pushes in what is shaping up to be a tightly contested presidential election. There's over 244 million people, so almost about a quarter billion people that are eligible to vote in the upcoming elections on November 5th. And in 2020, we had about 2/3 or 67% of people that were eligible to vote actually participated. So that is still a pretty significant number, right? 33% still not voting. So definitely, if you are a US citizen, resident, definitely do participate in the polls here. And the outcome of the next presidential election will hinge less on the voter turnout and more on the few thousand voters in the key battleground states, which are going to be Pennsylvania, North Carolina, Georgia, Michigan, Arizona, Wisconsin, Nevada, totaling about 93 electoral college votes. And of course, the majority, which is 278, is what's needed to actually win. Now, when it comes to the overall consensus to what people in the US are actually believing when it comes to the US economy, 6 in 10 Americans, which is basically 60% of Americans, consider the economy to be either fairly bad or very bad in terms of where we currently are. And even though there's been a very strong data point from GDP numbers coming in pretty strong, low unemployment rate, close to the pre-pandemic levels, many citizens feel they are worse off than they were 4 years ago. And that is primarily because of the disconnect between the economic data that's been coming out. Some people would argue that there's some cooking the books happening behind the scenes. However, I've really just dropped off that conspiracy theory. But yes, personal experiences, first-time views, first-time real hand on the ground experience is very different. And primarily because of inflation. As we know that CPI has been pretty aggressive. It's been at peak over 7 to 8 to 9%, although it has come down significantly after the Federal Reserve embarked on this significant rate hike journey, and we kind of peaked out at 5.3% on the federal funds rate. I'll go over the entire spreadsheet here in just a minute, so I've got all of that data here just for you guys. But of course, inflation being one of the big reasons why the US consumers are feeling the way they are, as there is a significant disconnect according to them, and they are worse off than they were 4 years ago because of higher prices. Kamala Harris has vowed and stated that her top priority will be from day one to lower food and housing costs for working families, and she plans to prohibit price gouging on groceries and assist first-time home buyers. And Trump has also vowed to quote-unquote end inflation and make America affordable again. So very important elections coming up. Like I said, this is not a channel to cover politics. I'm not gonna dive into this political debate, but really going over exactly what is going to be one of the most important market moving events next week on November 5th. Of course, I will be live to cover a lot of these things. Now, coming over to the, I would perhaps call this to be a little bit slightly more important for the market, and that's going to be the Federal Reserve meeting and the FOMC speech, press conference, everything. So that's going to be on November 7th. So this, by the way, is the earnings calendar, which is a little bit less important compared to what we just witnessed. Last week was pretty crazy. I mean, we had 5 of the top 7 companies in the world reporting. So we had Google, Microsoft, Apple, Amazon, Meta. All these companies reported. I was live for all of them to to listen in on the earnings call. We listened in on Google. We listened in on AMD. We heard what Mark Zuckerberg had to say for Meta. Then we tuned into Microsoft towards the end. And then, of course, we listened in on Apple towards the back half of it and primarily paid attention to Amazon. So we're, for the most part, done with some of the bigger names. But yes, next week we do still have companies like CVS, like Coupang, like Duke Energy, Applied Materials. We got Arista Networks, Vertex Pharmaceuticals, and even Palantir is reporting their numbers. So they're also scheduled to come out with revenues of 715 million, EPS at just about 9 cents per share. Vertex Pharmaceutical and Palantir are part of my shopping list as well. And of course, we had NXP, which is the NX semiconductor sector stock over there as well. Now, if you want access to pretty much the entire MoneyVest website, and I also posted my options portfolio week number 10 update that went out this weekend. Link's going to be down below. There's a few more spots left, and there's also the 16% annual discount that gives you 2 months for free. So link's going to be down below if you want to, of course, join, get access to all the trade alerts, options portfolio, weekly updates, MoneyVest website access, all the members only videos. Everything's going to be available with the link down below. Now, coming over to the spreadsheet. Now, this is the most important piece here for the FOMC, and the reason for that is because I really want to help you understand why the Federal Reserve is cutting so aggressively, right? We just went through a 50 basis point rate cut from the Federal Reserve. Now, what you'll see is the current rate for the federal funds rate is sitting at 4.83%. So that range is 4.75 to 5%. So that's where we're currently sitting for the Fed funds rate. The market's target range is 4.33%. So that's a range of 4.25 and 4.5%. And how do I know that? Well, that's the market's expectation. As you can see, there's a couple more 25 basis points cuts the markets are pricing in. One next week on November 7th, and the other one in the December meeting. So that's a 50 basis points worth of cuts is what the markets is currently pricing in from the Fed, coming down to 4.25 and 4.5%. So that is the market's target range. What has the Federal Reserve told us? Same exact thing. The Federal Reserve's target's also at 4.4% by the end of 2024. And that is, again, a range of 4.25 and 4.5%. Because that target sits between that range, and that is coming from straight from their SEP from the last FOMC meeting. So that right there, 4.4% is for 2024 federal funds rate target range is the number, right? So both the market and the Federal Reserve currently are aligned at two cuts, right? That's where we're both aligned. Now, the reason why the Federal Reserve is going a little bit faster on these rate cuts is because they are now tighter than where they were back in, let's say, March or September or even August. So what I mean by that is that if you come over to this is the table that kind of helps you understand things a little bit better. So what I have here is the core CPI, right? Because the Federal Reserve primarily focuses on core inflation when you exclude for food and energy. September, 6.6%. So this is September of 2022, so a couple of years ago. Core CPI was sitting at 6.6%. That was, in fact, the peak for core. Fed funds was sitting at 2.5%. So that real interest rate, right? So the real rate, net of inflation, was sitting at negative 4%. So we were literally sitting with negative interest rates. So that was obviously a very, very easy monetary policy. Lots of borrowing, lots of investing, lots of just cheap money floating around. And so interest rates were really low to borrow a lot of money and to invest and spend and save. However, when you move forward to March 2023, core CPI dropped a full 100 basis points, or 1%, down 5.6%. Fed funds rate sitting at 4.65 because we had 200 basis points worth of increases. And so the real rate dropped down to negative 95 basis points. Still negative, but a lot less. It was negative 1%, right? Almost negative 1%. So what does that do? So we really have to look at it from a perspective of real rates, right? I've talked about this concept on the channel before. And in fact, I was talking about it in 2022 and 2023, that the Federal Reserve is not going to stop until this rate turns positive, because that is when the interest rate policy is net of inflation restrictive. Until then, it is still accommodative, right? So there's the difference between accommodative and restrictive. Unless this real rate is positive, it's not really going to put a lot of impact on inflation. And guess what happened? As soon as August 23 hits, right? So there's not a lot of gap between March 23 and August 23. Core CPI drops another 130 basis points to 4.3%. The Federal Reserve increases rates more to 5.3%. That was in fact the peak there. And real rates turn 1% positive, right? So that is now a restrictive policy measure. Now, take a look at this. This is also even more interesting. The federal funds rate did not change between August 23 and August 24. So one full year, rates were as high as they've been in well over 14-15 years, since 07-08. They kept them there at 5.3%. And look what happened with inflation. Core CPI dropped another 110 basis points. And so we had that real rate pretty much more than doubled, from 1% to well over 2%. So now, without even lifting a finger, the Federal Reserve was able to be more restrictive, twice as more restrictive than where they were, say, a year ago. So that's why they're now becoming a lot more aggressive in cutting rates. So that's why the 50 basis points. However, I do still believe that the 25 would have been a lot more appropriate, because it would have given the time for the Federal Reserve to really evaluate the situation. The labor market's still pretty strong. Economic growth is still pretty strong. And the last thing the Federal Reserve wants to risk is for this number right here to rotate back up. And if you take a look at where we are for core CPI, that's exactly what happened, right? We went from 3.2 back in August of 24 to now sitting at 3.3. So we actually saw a tick up of 10 basis points for core CPI. And the real rate now, of course, sits at 1.5% because the Federal Reserve ended up cutting rates by 50 basis points. So, of course, we've come down from 5.33% back in August to now where we're sitting at 4.83%, right? So that's the current range. And the core CPI sits at 3.3. And so the real rate right now is 1.53. That's simply taking into account the current rate minus the core CPI. So real rate is 1.53. Now the target real rate is going to be 1.1 because that's where 50 basis points also priced in. That's how much the Federal Reserve is going to cut further. And we're going to be sitting at 1.1%. That is considering core CPI does not move. All things being equal, core CPI stays at 3.3%. Now look what happens if core CPI actually goes up 3.5, and then all of a sudden the policy becomes very accommodating again, right? So if core CPI starts to really accelerate back up to 3.7, now the real rates are back down close to zero. If core CPI starts to come down, right, 3%, or even 2.5, closer to the Fed's target, then we are once again looking at a very, very restrictive monetary policy, and that's going to force the Fed to cut rates further, which in itself is going to be a very, very good thing. However, we want to make sure that unemployment and economic growth doesn't worsen from here, because when that happens, well, the Federal Reserve will have no other choice but to lower interest rates further, a lot more aggressively, which then risks for this target real rate to push into the negative territory, becoming very, very accommodative again, and core CPI then risks accelerating back up. So it's really a balancing act from the Federal Reserve and what they're trying to achieve. But in my opinion, I think 25 basis points is pretty locked in for next week. That's really what we're going to see from the Fed. However, I'm not really sure if that's going to actually help the situation moving forward, because if you cut down another 50 or 25 basis points, we're going to be sitting roughly at around, let's say, 4.6. That's 25, and then 4.58, I guess, is where we'll be. And the target range, or the real rate, is going to come down to 1.28%. But then, of course, we're going to have to wait and see where core CPI is. So that's where we will be going into next week for another 25 basis points. The target real rate is expected to come down to 1.1%. I think that is a pretty good, appropriate policy rate from the Federal Reserve standpoint, but it all depends or hinges on where core CPI goes. So that, again, is going to be a very, very important number to watch out for. Now, one more thing I want to point out is what's really causing a lot of trouble or pressure to the market is the 10-year rate. We're almost at 4.4% again. So clearly, the Federal Reserve cutting 50 basis points, the market did not like that one bit, and the bond market's already responding not in the best way, pushing up to almost 4.4. And this right here is the entire pattern of the 10-year treasuries kind of trading inside this lower highs and lower lows downtrending channel. We're now coming up to this upper band of this lower high, so there could be some resistance for the 10-year treasuries. And in my opinion, I think it's now starting to become very lucrative to start looking into ETFs like TMF and TLT, considering how much they've been selling off. So if you come over to the daily chart, this is our entire analysis that I've done on this before. Let me just bring it over here maybe. I think it was. So again, trading down to low 40s is what I've discussed in the previous updates and previous analysis, where it's gonna make a lot more sense at around these prices, right? So $42 per share down to as low as $37.50 to as low as $38. Those right there are going to be very, very good support levels to start considering going long on the bond market once again, as TLT continues to drop as well, as we're seeing a pretty significant sell-off here down to low 90s again, and that is going to be that support. at roughly around $87 down to as low as $82 per share. So I will start selling some puts here on TMF. I think that would be a good starting point for me personally to start selling some puts at TMF of 42 strikes or 38 strikes depending on what kind of premiums I can generate. But that would be a good starting point for myself, as I do believe the 10-year treasury is coming into the upper range of their lower trend, is going to find some resistance in and around those levels. Now we're still going to see possibly another 25 basis points worth of cuts next week. Now coming over to volatility. Now elections, FOMC, earnings, there's just a lot on deck here, and volatility continues to be a little bit more elevated. And if you come over to where the MoneyVest index is, we are still in a pretty neutral zone. So MoneyVest index here, 3.36, that is considered neutral for the market. So from a risk reward standpoint, this is not an area where I'm, going crazy, dollar cost averaging aggressively. Although I did pick up some shares of VUG and SMH last week. However, if the volatility spikes further beyond 24, 25, given what we have coming up next week and the MoneyVest index drops below 3.5 or 3, possibly below 3, that would be the ideal place, because then we'll be in the uncertainty and fear and panic zones. That is the cue for me to dollar cost average a lot more aggressively. But either way, if there is any type of pullbacks in the S&P and the NASDAQ, and something that we have been seeing, so NASDAQ here starting to already roll over from this downtrending channel, as we discussed. So let me just pull that up here very quickly. It was, which was the chart? I think it might have been this one here. So IXIC here on the daily time frame. There we go. So this was the chart that I was talking about in my previous updates. That's the rising wedge for IXIC. Again, you can see the NASDAQ composite kind of coiling inside this rising wedge. Nice little breakdown, and support level next is going to stay put at 17,700. And of course, for S&P 500 also starting to roll over here. A nice little pullback of over 2.5%, but the lower it gets down to, the better the opportunities will be. So I am ready to deploy capital into the market next week. I will be putting money to use, closer to $10,000, maybe $20,000 of worth of buying individual stocks, ETFs. So again, I'm sharing my plan before I execute it. So the MoneyVest index needs to come down below 3, volatility above 25, and the market's giving us some nice buying opportunities, and I will be ready to deploy $10,000 as much as $20,000 between stocks and options in the next couple weeks here if we get those opportunities. So my shopping list is ready, my plan is ready, my buy targets are ready, my options are ready. So we'll just, the only matter is the market's giving us the opportunity so we can execute on our plan. So if you want access to all of this, all the trade alerts, find out exactly what we're trading, what we're buying, selling every day, join our community, join our MoneyVest platform. Link's going to be down below. The first week of the month is the best time to join. If you have any questions, please feel free to reach out, and get ready for what's going to be one of the biggest weeks in the market. As always, happy investing, and I'll see you all in the next video.